In the late 1990s, a revolution was brewing, not on the streets, but on the glowing screens of bulky desktop computers. This was the dawn of the internet age, a digital frontier promising untold riches. The NASDAQ, the tech-heavy stock index, wasn't just climbing. It was launching into the stratosphere, fueled by a collective belief that this time, the old rules of business no longer applied. Across the country, ordinary people transformed into day traders, mesmerized by the hypnotic dance of rising stock tickers. With a dial-up screech and a click of a mouse, it seemed anyone could tap into this new digital gold rush. The media fanned the flames, splashing headlines of the new economy and tales of 20-something tech founders becoming overnight millionaires, creating a powerful sense of FOMO, the fear of missing out on the greatest wealth creation event in history. The boom escalated into a full-blown mania, a party of a lifetime where logic was the first guest to be shown the door. The new rock stars were dot-com CEOs, taking the stage not with guitars but with bold, often baseless promises. They pitched ideas, not products. Eyeballs, not earnings. A company with a com in its name but zero profits could launch an initial public offering and be showered with billions in venture capital. This was the era of growth over profits, a mantra that justified pouring mountains of cash into ventures with no clear path to profitability. The celebrations were as legendary as the valuations, with companies spending lavishly on extravagant parties, Super Bowl ads, and corporate jets, all while their balance sheets bled red ink. It was a dizzying, delirious spectacle of irrational optimism. But no party lasts forever. As the new millennium began, the sobering sounds of reality started to cut through the noise. From the podium of the Federal Reserve, Chairman Alan Greenspan, who had once coined the phrase irrational exuberance, began to signal a change in tune. A series of interest rate hikes throughout late 1999 and early 2000 made borrowing more expensive, tightening the flow of easy money that had fueled the speculative frenzy. The music was slowing down. On screens across the world, the once unstoppable NASDAQ graph hit its dizzying peak in March 2000. It teetered for a moment, a fragile pinnacle of hope and hype, before the first cracks began to appear. That familiar thrill the 1990s investor felt was replaced by a gnawing anxiety as the vibrant green numbers on his screen began to flicker, then fall. What followed was not a correction, but a cataclysmic collapse. The NASDAQ didn't just fall, it plummeted, wiping out trillions of dollars in market value in a breathtakingly short period. The darlings of the digital age, companies like Pets, Com and Webvan, which had once been heralded as the future, went bust in spectacular fashion. Their logos, once symbols of infinite potential, exploded into digital dust. The lavish offices of the dot-com CEOs grew dark and silent, monuments to hubris and broken dreams. The everyday investor who had bet his savings on the promise of a new era could only watch in despair as a decade of gains vanished. Yet from the rubble of this digital apocalypse, a few resilient giants did emerge. Companies that had focused on building real businesses like Amazon and eBay not only survived the crash but rose to define the very future the bubble had promised. It was a brutal lesson in the enduring power of value over hype, leaving behind a landscape forever changed by the chaos of irrational exuberance and the giants it left behind.